On August 19th, the South Korean stock market didn't just dip, it violently cracked. The KOSPI plummeted a massive 5.80%. We're not talking about your run-of-the-mill market correction here. This was an urgent structural shockwave that literally vaporized billions in value in a matter of hours. Let's dive right into exactly what happened in today's explainer. Just to give you a sense of the sheer scale of the carnage, the market was an absolute sea of red. Out of the 942 stocks listed on the KOSPI, 703 of them went into a complete freefall. There was basically nowhere for investors to hide. The index eventually closed out the day at 6,471.17. But honestly, the chaos started the second the opening bell rang. A brutal 6.02% drop in KOSP 200 futures was so incredibly severe it actually triggered a sell-side sidecar. That's essentially an emergency brake for the market, freezing automated selling just to prevent a catastrophic total collapse. But here's the real mystery. The trigger for all of this? It wasn't even domestic. This financial earthquake actually started overseas. It was driven by a massive surge in global oil prices, with WTI crude pushing past $85, right alongside a sudden, really aggressive spike in global inflation fears. The primary spark for this was entirely geopolitical. Escalating tensions between the US and Iran, plus naval blockades threatening vessel traffic in the Strait of Hormuz, completely spooked the markets. It's a classic reaction. Whenever global energy supply chains are threatened, the entire market instantly reprices risk. Now, when you combine those soaring oil prices with a looming reality of a heavy U.S. fiscal deficit, which of course requires issuing more Treasury bonds, well, something had to give. That immense pressure forced the U.S. 10-year Treasury yield up to a very hot 4.71%. And the bond market sell-off absolutely didn't stop there. The 30-year U.S. Treasury yield shot up to an intraday high of 5.34%. To put that into perspective for you, that is the highest level we've seen for the 30-year yield since 2007. Yeah, right before the global financial crisis. So how exactly do bond yields cause a stock market crash? Think of interest rates like financial gravity. It all comes down to the discount rate. When long-term yields rise, the discount rate goes up, and that mathematically pulls down the present value of a company's future cash flows. Which brings us to the big tech players. How does a shift in U.S. bonds specifically threaten Asian tech? Well, higher yields directly raise the cost of borrowing capital. And this is a huge threat to the tech hyperscalers. You know, those massive global companies pouring billions and billions of dollars into building brand new AI data centers. It creates this brutal domino effect. Higher treasury yields mean that the corporate bonds these tech giants use to fund their massive infrastructure suddenly become way more expensive. Ultimately, those higher borrowing costs force them to slow down their AI investments, simply because new projects now require a much higher return to actually turn a profit. And that caution ripples straight across the Pacific. Slower AI investment directly lowers the expected future demand for advanced memory chips, like high-bandwidth memory and DRAM. Those are, of course, produced by Korean industry titans like Samsung and SK Hynix. The end result was an absolutely severe blow to Korea's tech giants on August 19th. Samsung Electronics plummeted 7.82%, and SK Hynix dropped an agonizing 9.75%. What makes this so devastating is that it violently wiped out a really strong 5-day rally we were just starting to see in memory chips. As prices collapsed, a massive battlefield emerged in the market. On one side, you had fleeing foreign capital executing 3.5 trillion won in net selling. And on the other side, aggressive individual retail buyers stepping in, trying to catch the falling knife, net buying 4.64 trillion won. But here's where the data gets absolutely fascinating. A staggering 82% of all that foreign selling across the entire KOSPI was concentrated in just two names, Samsung Electronics and SK Hynix. Foreign investors were essentially dumping Korean tech wholesale. This brings us to what we'll call canary number 2. Individual retail investors stepped right up and absorbed nearly all of that massive institutional dumping of these two specific tech stocks. Everyday retail buyers basically matched the institutional outflow almost dollar for dollar, which makes canary number 1 even wilder to think about. Just days prior to this massive crash, foreign investors had been heavily accumulating, net buying 3.93 trillion Korean won in SK Hynix over a 4-day streak. Then, in a sheer panic, they dumped 46% of that entire accumulation in a single trading session. Talk about whiplash. Okay, let's pivot away from the stock market for a moment to our final point, canary number 3. There's a lingering structural mystery buried deep in the domestic Korean bond market that completely contradicts everything we just saw happening in the US. Unlike the United States, where long-term yields were skyrocketing to multi-year highs, Korean domestic bond yields actually fell that day. The Korean 3-year government bond yield dropped by 5 basis points, and the 10-year yield fell by 4.6 basis points. Which leaves us with a really massive structural anomaly. Remember our rule of financial gravity from earlier? Falling yields usually lower the discount rate, which is supposed to raise stock prices. So if Korean bond yields actually fell, why did the KOSPI plummet 5.80%? That disconnect between domestic bonds and equities is the vital puzzle I want you to take away from this explainer today. If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.